All right. Today is Monday, the 16th of January, and this is a recap for the stock market activities last week and an outlook for the week to come. Now, folks, I got a good one for you today, and I'm serious. This is going to be one of my best episodes, even by my own standards. Now, you might be saying, hey, Maverick, what's up with the early upload? You forget about something? No, I forget about nothing. But maybe you forgot that today the market is off, so whatever trades you think you did today, you probably just got scammed by a bunch of Bulgarian hackers. Why is the market off, Maverick? The answer is Happy Martin Luther King Day. MLK, baby. I'm not sure if you've seen the new MLK statue in Boston. Take a look.
All right, now to what has us in fits and giggles this morning. A new sculpture is unveiled in Boston commemorating Dr. Martin Luther King Jr. and his wife, Coretta Scott King. The 22-foot-tall bronze statue is called The Embrace. The artist says it was inspired by a photo of the couple embracing moments after Dr. King was awarded the Nobel Peace Prize in 1964. Despite the good intentions, though, it has left many confused, trying to see the embrace. What else might you see? I mean, everybody's wondering, like, can we see this from a different angle? I've been trying to see the embrace, ladies, and it's difficult, right?
And I don't know if you saw this or not on Twitter, but even MLK tweeted from his grave about it. Absolutely tragic. These are the people who call themselves artists. In reality, they're just mentally ill. What else? When it rains, it pours here in California. I mean, this is a historic one. Now, I want you to catch what is inflationary about this storm. Let's take a look at this report and see if you can catch it or not. Take a look.
California now, where there is no end in sight to the waves of powerful storms hitting the Golden State. So far, at least 19 people have been killed. CBS's Danya Backus is in Los Angeles tonight with the latest. Danya, good evening.
Good evening, Adriana. A state of emergency in Los Angeles and the rest of the state as this new storm moves in. 26 million, or two-thirds of California residents, are under a flood watch. Heavy rain slams into Sacramento Airport. A roadway collapses near the Northern California coast, and there's flooding throughout the state. This warning from Governor Gavin Newsom.
This is just the eighth of what we anticipate will be 9 atmospheric rivers. We're not done.
It does seem to be coming up pretty quick, guys.
Emergency evacuations issued again for parts of Central California as rivers, including the San Lorenzo, keep rising.
You guys are going to flood again. Let's just face reality here.
In Salinas, fears the river there could breach its banks and flood the country's salad bowl, where 70% of lettuce is grown. The April harvest is in jeopardy. Another threat, a flooded highway that could isolate the Monterey Peninsula.
It's concerning. People are being flooded. Roads are being inundated.
Statewide, many roads are washed out. Hillsides have given way, and asphalt has collapsed, creating growing sinkholes like this one that began Monday in Los Angeles. In the Sierra Nevada, a warning to holiday travelers to stay off the roads due to dangerous snow. For storm-weary Californians, it's an anxious wait and see.
Just hoping for not too much property damage.
So for one thing, lettuce prices, among many other products from California, will definitely rise in price in the next few months. On top of that, this is the most populated state in the country. So all of this repair and rebuilding effort means a sudden surge of demand on scarce raw materials. That is also inflationary. Now let's talk about the market for a little bit, because as you might be well aware, 2022 has been a rough year for the market. How rough was it, Maverick? How about the number of expletives in corporate earnings reaching all-time highs last year? And you know what? 2023 will shatter this record. But in the meantime, we have a big market rally on hand so far this year, and they gotta start feeling comfortable before the rug is pulled in the most epic fashion you will ever see in your lifetime. And the good news is, they're getting comfortable. For example, so far this year, money managers conducted one of the biggest outflows from value stocks in history, in favor, of course, of growth stocks. Now, historically speaking, value stocks tend to outperform in bear markets, while growth stocks tend to outperform in bull ones. So, are we in a bull market finally? Let me tell you a little secret, since I used to be a money manager. Most of these people are sheep, brainless zombies who follow whatever other managers are doing. The herd mentality says every year, sell the winners, and buy the losers. And this is all what we're seeing right now. On top of, we're also seeing the market fighting the Fed once again. More on that in a minute, but the experts, quote unquote, now say that inflation is dying. And this is the final phase of the bear market. Bye, 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 bye. For example, your boy Tom Lee says that we are in deflation. This is deflation. What you're seeing around you, that's deflation. It's over. The Fed is about to cut rates. And you even got the good professor from Wharton, who's in reality just another corporate hack. He says that inflation has been solved. It's over. It's gone. Meanwhile, eggs prices continue to surge, and so is everything you buy at the grocery store, not to mention your rent, utilities, etc. The criminals of BlackRock say that they're optimistic about 2023 for long-term investors. Now, this is bullshit. It's their insurance policy. In case 2023 turns out to be a horrific year, they come out and say, well, we said for long-term investors, not in the short run. You might be holding a bag right now, but it's good for your muscles. And the bulls are charging and defying the Fed. Who cares what the Fed says? They're bluffing. They're gonna crack. They're gonna cut rates. And higher we go. Fight the Fed, baby. Same people, by the way, during the mania bubble, been telling us not to fight the Fed by shorting the market. Now, all of a sudden, they think that fighting the Fed is a good strategy. And look, historically speaking, when the first month of the year ends up being positive after a bear market last year, or the year before, I should say, well, the market could end up being up or down for the remainder of the year. Up in the 2009 case, down in the dot-com bubble bust case. Now, remember, the only reason we did not go into a Great Depression in 2009 is because the Fed's intervention. And the question is, will 2023 be similar to 2009 or the dot-com? Well, that depends on what the Fed will do and, most importantly, what inflation will do. And with that out of the way, let's dive right into it. And here it is, in focus today. Tough call. Will the Fed stand strong or will they buckle? This is the biggest challenge Jerome Powell and company have ever faced so far. Forget about transitory. That was nothing. This is the one. This is the one that will shape the remainder of the story that we've been tracking for at least 2 years now. The boom and bust. And if the Fed makes a mistake one way or the other, the consequences will be dire. Now, before we start, I'd like to visit the Wall of Worry. And we have, of course, one of the items on the Wall of Worry, besides the Fed, we also have Washington, D.C. and the fiasco and the chaos that happens from that filth town all the time. This time around, we have a debt ceiling problem, and this could be a big one. And if we don't have a deal, and the Treasury Department has to conduct some extraordinary measures, as Janet Yellen says, it could rile up the market in a big way. Take a look.
We're going to turn now to a critical time in Washington. Congress is on the verge of a political showdown after the Treasury Secretary warned lawmakers that the U.S. is projected to reach its debt limit on Thursday. ABC's M. Nguyen has the latest now from Washington. M, good morning to you.
Good morning, Gio. Treasury Secretary Janet Yellen is urging Congress to quickly pass legislation to either raise the federal debt limit or temporarily suspend it. Now, that deadline is January 19th. That's Thursday. And Yellen says before the government will have to resort to, quote, extraordinary measures to avoid defaulting on the nation's more than $30 trillion borrowing capacity. Failure to address the debt ceiling, she says, would cause irreparable harm to the U.S. economy. Some analysts suggesting a default could crash financial markets and potentially lead to a credit downgrade. And if the issue drags on, it could lead to a partial government shutdown. Raising the limit does not mean more spending, but rather just allows the government to finance existing obligations, including tax refunds, Social Security, and Medicare payments. Debate over the issue will almost certainly trigger a major political showdown in the House between Republicans, who now have control, and Democratic lawmakers. House Republicans have pushed back, expressing interest in using these negotiations to cut spending. Now, the debt ceiling was raised 3 times under the Trump administration without issue when Democrats held the majority. And now Democratic leaders say there's no reason Republicans can't do the same. Gio.
Now, transitory Yellen says that the U.S. will hit a debt ceiling Thursday, and the analysts warn of significant market pain in that while Congress deals with the limit. Here's the problem. Remember all the fiasco with McCarthy and the Republicans? Because every time we have this debt ceiling problem, they make a little bit of drama and then they come together and they raise the debt ceiling because they're all corrupt and they're all beholden to corporations. But this time around, it could be consequential. You got all of these Republicans that took over the House, but specifically McCarthy, who made all of these promises that he's going to lead with the conservative way, no more spending. Well, now he has to face the choice. The country will go into default, or he has to agree to raise the debt ceiling higher. Now, which one do you think he's going to go with? I think the answer is obvious, but in the meantime, it could be a fight, it could be a negotiation process. And with that comes a lot of uncertainty. The stock market doesn't like uncertainty. The other item coming from Washington, D.C. that we have to worry about, at least maybe keep it in mind, is what's going on with Joey B. All of a sudden, they have these classified documents they found in Joey B's garage along with the Corvette. First of all, Joey B driving Corvette, avoid. That could be a disaster. But this sounds a little fishy. Why now? Why all of a sudden now? We're hearing about some classified documents in Joey B's garage. Look, it is absolutely hilarious to watch the media and how they are twisting themselves into a pretzel to justify this. But my tinfoil hat says this could be the beginning of the process of giving Joey B the pink slip. By whom, you might ask? By they. Quote unquote. Who's they, you might ask? I think you know the answer. For now, I don't think this is a problem for the market, but if it becomes chaotic, if it becomes a fight, and all of a sudden we have Joey B allies, I doubt it, but if we have some, and they stand against whatever the plan is to replace him, that could be a big problem for the market. So this is what we're watching for now. We're keeping an eye on that. Now, another item in the wall of worry is the Fed and their tightening campaign, and what the impacts of this campaign are in the economy. We have a little hint for now. All eyes are now going to be on earnings, but we got a little hint this week from banks. The headline from the Journal reads, America's biggest banks are girding for a recession but are not feeling one yet. And I say really? Because big banks are setting aside $4 billion for a recession, but investors see no problem with that at all. Yeah, banks are just overreacting to what's going on in the economy. Now look, when it comes to banks' earnings, we have the good, we have the bad, and the ugly. And I always say, I don't like investing in financials at all. I've never seen them as attractive investments at all. But if you must invest in one of them, pick the top criminal organization of them all, JP Morgan Chase, aka the Landromat. Because JPM is the best performer among banks, they top the estimates. Revenues, profits, everything is good. But they say that a mild recession is now the central case. So Mr. Hurricane is now being downgraded to a tropical storm. And I say when Mr. Hurricane says he's downgrading his bearish outlook for the economy, prepare for a tsunami. Now we talked about the good, here's the bad. Citigroup fourth quarter profits declined by 21%. Nothing to see here, right? The economy's fine. We're just going to have a soft landing now. Inflation is dead. It's over. And here's the ugly. Wells Fargo shares fall, at least they fell initially, until the geniuses bought the dip because their profits were cut in half. Whoops. And the reason is they're setting aside a lot of reserves for the worst case scenario. Now you put two and two together, Wells Fargo just announced that they're getting out of the mortgage market, at least for now. They know that there is a massive bomb about to be detonated in the mortgage market, in the housing market in general. It doesn't matter. With all of these geniuses who took mortgages they cannot really afford, once they lose their job, and they will, we're going to see an epic disaster, the likes that we have not seen since the great financial crisis in 08-09. Now again, here's for you bank investors. I bet you guys are a bunch of dorks, but if you have to invest in banks, stick with JP Morgan because the net interest income for JP Morgan exceeds all of them combined. Avoid Citibank, that's a trap. Avoid Wells Fargo, that's another one. Stick with either JP Morgan Chase, that's number one, the best, or Bank of America because when we look at the revenues and profits year over year, the only banks with positive returns year over year, JP Morgan, Bank of America. Citigroup and Wells Fargo are an absolute disaster. Now, with that out of the way, let's talk about the subject of this program tonight or today. Whenever you get it, doesn't matter. This is the most important decision that the Federal Reserve will ever take, a decision or lack thereof. Folks, I've been reading your comments and I've made a lot of predictions, a lot of forecasts throughout the last few weeks. Some bearish and recently some bullish. A lot of you are saying, hey Maverick, what's up with the flip-flopping? What's up with the confusion all over the place? It all depends on what the Fed is about to do. And I'm going to summarize everything I've been talking about in the last few weeks in this episode right here. So pay attention now. In the aftermath of the recent CPI and the outrage by the Wall Streeters and the corrupt politicians who are urging the Fed to stop raising interest rates because inflation is gone. If they continue to do it, they're going to dip the economy into a recession, an unneeded recession, because the job market is pretty good. Jobs are plentiful. That's what they say. Yet inflation is going down. This is the soft landing. Why would the Fed ruin the party? So the Fed has two choices: either to listen to these morons, accept the current success, perhaps pause and even ease, or choice number two. And Jerome Powell, if you're listening, you better take some notes. Stick to the plan until the job is done. What is the job is done? It means inflation is gone for good. Now, if you know anything about Economics 101, if you spent at least 5 minutes in any history class, you know that every major inflation cycle ended up in a recession. There hasn't been a single case when we've seen inflation as we're seeing today, and everything ended up where everybody lives happily ever after. Because to kill inflation at this stage, when you're too late to the game, you have to reset the cycle. And resetting the cycle means dipping the economy into a recession. That is the only proven way so far to get rid of inflation once and for all. Now, with that understanding out of the way, let's play some scenario analysis. Let's say the Fed buckles and says, okay, we've done enough. Now it's time to pause and perhaps ease interest rate hikes, even cut. What's going to happen? The equities market will rally by 8%. And the dollar is going to plummet big time. Now, why do I say that the stock market is going to rally by 8%? Remember, I issued a forecast. I said in the bullish scenario, the bulls will make it above 4,000 in the SPX. They will crack above a major resistance line, the sloping line that you see. And once that happens, everybody and their mothers will become bullish again. And this rally could take us all the way to 4,325.28. That could be a rally worth about 8% or so. Now, here's the problem. If we have a stock market rally of 8% and everybody says that the bear market is over and here comes the new bull market and the dollar on top of that plummets big time, what are the end result of all of this? The answer is financial conditions will ease and inflation will rebound, because when the stock market rises higher, that loosens financial conditions. People feel more confident, they start spending in the economy again, they start borrowing, etc., etc. When the dollar goes down, that's inflationary because commodities are traded via the dollar. When the value of the dollar goes down, demand rises on commodities overseas. That is inflationary because it pushes the prices of commodities higher. And so long as the underlying conditions for inflation remain intact, remember, we're declaring inflation is dead while inflation is at 6.5% year over year, and that is the cooked number. In reality, inflation is much higher. This is absolute lunacy because part of the conditions that keep inflation alive is a law called the aggregate demand, meaning prices go down, but if people still have the credit card, they still have inflationary wages, they still got their jobs, and they believe that we have a soft landing, the Fed is done with the tightening, what are they going to do? They're going to start splurging again. That is inflationary. That is aggregate demand. When price goes down and we see demand rising higher at this new price level. For example, got a recent one here. Tesla, the souffle, drastically lowered prices for their EVs, Model Y specifically, and immediately people are now stampeding on these souffles like they're going out of style. Even I'm thinking about buying one. I'm not even a fan of the souffle, but it could be a good business decision. If you buy it right now and then demand increases later on, you could flip it for a profit. And this will happen with housing. This will happen with appliances. This will happen with used cars. This will happen across the board once again if scenario number one takes place. So what is the end result of all of that when financial conditions ease and inflation rebounds? Well, the Fed will have to come back again and raise rates, this time around more aggressively. What is the problem with that? Hold that thought. We'll revisit it in a minute. But before we do that, let's talk about scenario number 2, which the Fed says, you know what? I don't care about you whining and bitching. Jerome Powell is now Dark Powell, and he doesn't care. He wants to get the job done, even if it means losing your job, even if it means losing your mind. If that is the case, then my initial analysis and forecast takes place. Stocks will plummet by 20%. Why am I saying that? Look at this. This is the monthly chart of the SPX. We have a defined trend line that goes all the way till 2009. The market is not going to bottom until we reach this line. It could pierce below it, but this will be a good point for a debate and a reassessment whether it is a bottom or not. But the stock market is not going to bottom before this line, this major trend line, if the Fed continues with their tightening campaign. And from this point on, it could be a decline worth about 20% or so. So this is where the 20% comes from. And by the way, this is the same forecast by your boy from Morgan Stanley, Mike Wilson, who says that stocks will go down by more than 20%. What will also take place is a rebound in the value of the US dollar. This is, of course, in the case where the Fed sticks with their tightening campaign until the job is done, quote unquote. What is the end result of all of this? Number one, financial conditions will tighten. Number two, inflation will weaken for the wrong reasons. The combination of these two elements is a recession. Now, why should we hope for scenario number two and not scenario number one? The answer is because if the Fed eases right now and listen to the morons and we see a rally in equities, the dollar goes down, inflation rebounds, and then they come back in a revisit of the tightening campaign and they raise rates even higher than anticipated, guess what? At that time, the economy will be a lot weaker than it is right now. Take, for example, what's going on with the tsunami of layoffs. Carvana is now cutting more jobs than anticipated. You think if the Fed says, okay, we're not going to raise interest rates anymore, perhaps we're going to cut. You think Carvana is going to rehire all of these people? Of course not. The damage has been already done. You got Goldman Sachs laying off employees in the nastiest way possible. They emailed these employees saying, hey, we have a meeting, a regular conference meeting that you should attend. Once they attend this meeting, they find out that this is a trap. This is a meeting where they say, hey, you lost your job, sorry, goodbye. But folks, here's where the opportunity resides. Let's say the Fed wimps out, as Dr. Rubini says, and we see a stock market rally and the dollar goes down. This is the worst case scenario in the long run. But can we trade it in the short run? The answer is yes. How do we trade it? By going long energy, because the dollar is going to go down. With the China reopening crap, you're going to see energy rebounding in a big way. And again, that is inflationary. Inflation rebounding higher. You got to play this one. Take, for example, Morgan Stanley, who says that tight supply will support oil prices in the second half of this year. Goldman Sachs now says oil rebounding to 110 by the third quarter. Unbelievable. On top of that, you might say, hey, Maverick, why not play it by buying chips or technology or whatever? The answer is energy has the best fundamentals. If the Fed is going to wimp out and cause inflation to rebound, you really don't want to be in tech. You might want to trade it, but we're going to have a problem with tech earnings. We're not going to have that much problem with energy earnings because we know that the fundamentals remain intact. They have the best earnings by far. And if energy goes down for whatever reason because of earnings, that would be a buying opportunity, assuming that the Fed is wimping out and the dollar is going down. In summary, ladies and gentlemen, when you comment on this channel and you say, Maverick, you're all over the place, am I really? Or am I just following and giving you scenario analysis based on what the Fed is about to do? And now you know, scenario number one, you're going to trade technology, the high beta names higher, but you might want to buy the dip in energy because that would be the leader. And then, of course, one of those readings of the CPI, we will see a major rebound where, oh, whoops, inflation went higher again. And that would be the moment where equities go down across the board in a big way because we realize at that moment that the Fed will have to come back with more aggression. Only this time around, the economy is more damaged and wounded. Scenario number two, we stick to the plan. We're going to see a crash in the stock market. The dollar is going to rebound. You don't want to be in energy here. You want to be in the recession type stocks. The stocks that everybody's dumping right now. Value, healthcare, consumer defensives, even utilities. You want to be in the most boring stocks ever. Anyways, am I clear now? Is this easy to understand? If it's not, that's your problem. Now, let's move on to the coverage of the stock market, and we begin with the closing of the indices last Friday, and here we go. The Dow Industrial Average on Friday up by 112.64 points or a gain of 0.33%. The Nasdaq in the green by 78.05 points or a gain of 0.71%. And the S&P also in the green by 15.92 points or a gain of 0.4%. Now here's the important part when we look at the sectors' performances on Friday, mostly in the green, all of them, with the exception of the defensives in utilities and real estate. Who needs those right now, right? But it could be a buying opportunity in the long run. In the meantime, at number one, capturing the gold medal, cyclicals. At number two, for the silver, Communication services, number 3 for the bronze, a rebound for healthcare. However, when we look at the weekly performance for the sectors, healthcare, not so good. The laggards, matter of fact, utilities, healthcare, and defensives, aka the recession types. So for now, the market is betting on scenario number 1 that we just talked about, in which, at least in the initial stage, at number 1, capturing the gold metal, cyclicals, number 2 for the silver, technology, number 3 for the bronze, materials. Although energy is moving slightly higher, little by little, until it takes the lead so long as the dollar continues to go down. When it comes to the advance to decline ratios, slightly down from the 70s, advancing, now we're back to the 60s, soon enough we'll be back to the 50s and then negative again. But in the meantime, NYSE on Friday, 61% advancing versus 37% declining. The Nasdaq, 62% advancing versus 34% declining. On to commodities, here's the closing on Friday. Inflation is dead, you say, but commodities are disagreeing. They continue to move higher for the most part. For example, the WTI on Friday up by almost 2%. Brent up by a little over 1.5%. So did gasoline, up by over 2.5%. Heating oil up. The exception is natural gas, down by about 6%. But I see natural gas up today, at least so far, and crude down. The volatility in natural gas is not natural, shall we say. For example, I'm starting to become a little more suspicious about this Freeport LNG facility. My tinfoil hat says, just like we said before, Nord Stream did not blow itself up. We ended up being right, despite the morons saying, "Hey, Maverick, your propaganda's for pooping." By the way, speaking of pooping, we're going to do an update for Sticking It Up and Brah, maybe tomorrow. But in any case, really, the Freeport facility is now delayed again. This thing been blown up last year, and it's taking this long to repair the facility and get it back in order? Or is it a manipulation tool? Blow up the facility to create an illusion of lack of demand until natural gas prices go down by a lot and you achieve your agenda, and then put it back in order. We'll see what happens. But anyhow, when we look at softs, lumber has been rebounding as of late, continues to move higher. The same goes for coffee futures, continues to rebound, this time around by almost 1%. And then we have more modest gains for cocoa, cotton, and sugar futures. The laggard on Friday, OJ, down just slightly, almost in the flat line. When it comes to metals, the dollar was flattish, but we know the story now. We got the confirmation. It's going to go down. The rally in metals continue. We got gold up, silver up, copper up. The notable absence coming from platinum and palladium. Platinum, of course, down by almost 1% on Friday. We're not seeing a lot of movement as of late in meats futures, although feeder cattle futures were down by almost 1% on Friday. When it comes to grains, muted across the board, slightly to the green, with exception of soybean meal futures down by a little over 1% on Friday. And of course, notice the rally in the Japanese yen. I think the yen is down today, but the rally is notable. The message is clear. Dollar is going to go down, yen will go higher. The Bank of Japan is absolutely screwed right now. And the reason is they have to continue to tighten. But the dollar going down, that's inflationary. Energy prices will continue to move higher. Metals prices will continue to move higher. And the Bank of Japan, as I said, they're absolutely screwed because they have to continue to raise higher and higher and higher. And they're not going to see a lot of effect because the dollar going down, that's inflationary. Now, moving on to the big casino, the options market, what do we see here? Not a lot of action on Friday, believe it or not, although the volume rebounded higher in a big way for Tesla, the souffle. Now, look, a lot of folks are looking at the news that Tesla's cutting prices. That is a sign for problems in the company. And perhaps it is, but could it also be a source for optimism? The answer is yes, it could. When Tesla reduces prices by this much, almost 20%, that's a huge discount. They put companies such as Ford, GM, even Mercedes at a disadvantage because now the buyer has choices. And if they like a Tesla, but maybe it was not accessible to them, and they're going with a GM or a Ford, now Tesla becomes on the menu, and Tesla takes business away from Ford and GM. Now, if this assumption is right, this could be a big positive catalyst for Tesla, and therefore we're seeing the options volume surging higher by almost 4 million contracts on Friday alone. They're buying more calls than puts this time around. It's almost 50-50, but slightly positive toward calls. When it comes to Amazon, at number 2 with around 1.5 million contracts traded on Friday, about 56.5% of those were calls. Now, Amazon has been the outperformer as of late, but watch the charts. If the RSI starts to get really overbought, it could be an opportunity to bid the other way for a pullback in AMZN. Now at number 3, with huge volume, Bed Bath & Beyond BBBY. With around 1.3 million contracts traded on Friday, the stock was down by over 30%. Of course, the volume was mostly positive, people betting for a rebound. About 56% of the volume was calls, not puts. Now look, when the implied volatility in these things surge higher to 100%, even if you bought puts beforehand and the stock goes down by 30%, you didn't make a lot of money because they were overpriced to begin with. Likewise, if you're going to buy calls, even if the stock is up by 50%, you're not making a lot of money because the premiums are too high. So in trading options, you're better off chasing an increasing implied volatility, not a decreasing one, because in an increasing IV rank, you're buying at a cheap premium while the prices are set to increase. Your goal in trading options is to flip them for a profit. So buying at a high or exaggerated implied volatility, that is a bad strategy. And more likely than not, you're going to lose your money even if the trade goes your way. On to the unusual activities that took place in the options market on Friday. I noticed that the bets were shy. They were not betting a lot. Perhaps it is MLK Day, the holiday. Could be uncertainty about the direction of the market from this point on. In any case, the volume was down all in all. The bets were down all in all. But we do have MBLI, this is Mobileye, a company that outperformed last year, ended positive, but it was down big on Friday, down by a little over 4%, and somebody sees more declines to come. They bought the 25 puts for the expiration date, February 17th, with expectations that MBLY could move down and lose more than 24% of its value by then. It's a major bet. They paid around 45 cents apiece to enter this trade, all in all, spending around $200,000. And then we have the IWM, the Russell 2000, the outperformer as of late. I sold all of my calls. I'm done with it. Am I switching to puts? Perhaps. Because we have this trader who bought the 177 puts for the expiration date, March 17th, with expectations that the IWM could move down and lose more than 5% of its value by then. They paid around $3 apiece to enter this trade, all in all, spending around $1 million. On to the heat map analysis. This is the heat map on Friday. Again, mostly in the green, led by financials on the heels of earnings, even though a lot of them did not do that good. Wells Fargo, that is not justified at all. With that being said, we're seeing a little pullback in chips, although Nvidia moving higher. Notice that Nvidia trades with the Chinese names hand in hand. The recent rally in Chinese names, Alibaba, Pinduoduo, also lifting Nvidia higher. Absent from the rally on Friday, the defensives in utilities, in REITs, but also in EVs, because we have Tesla lowering prices. Tesla was negative for the day, but it did outperform Ford, GM by a lot. And I think Tesla will continue to outperform at this point, so long as the assumption that a reduction in price equals increasing demand. If that theory is dented by whatever piece of data we get, then Tesla in a major trouble. Among the underperformers, of course, UNH in healthcare, United Health Insurance, that's down even though they reported earnings. That name is toast. The technicals are bad. It's a short from this point on. And again, among the underperformers, for the day, for the week, once again, the defense contractors, they were down big. Northrop, Lockheed, Raytheon, General Dynamics, all down big. And the reason is we have a clown from Goldman Sachs who downgraded all of these names. Now, I got the paper from the Journal this weekend, and the front page, the headline is Biden, Kishida, this is the Japanese PM, tout defense ties at the White House meeting. In other words, Japan wants to buy more shit. Lockheed, Northrop, Raytheon, you know the deal. The other headline reads, the White House to ask Congress to approve F-16s for Turkey. And if you read the article, they're also approving the F-35s for Greece. And this will be the biggest sale on record. But this clown from Goldman says that the defense business is slowing down. What are you talking about? On the other hand, on the same page, the headline for Goldman reads, Goldman consumer business stung by losses, down $3 billion. Who's in trouble now? Lockheed, Northrop, the defense contractors, or Goldman Sachs? I say to the clown from Goldman Sachs, worry about your own house. But here's the heat map for the week. Again, not a lot of difference here. The weakness, once again, in the recession type of trades. The big pharma, Pfizer, AbbVie, J&J down big. Even Merck is down. The utilities underperforming along with the consumer defensives. These are all good names to own in a recession. But of course, they're underperforming because the market is assuming that the bear market is over. What recession? What are we talking about here? We have a soft landing. The bull market is back, baby. And therefore, we see also the defense contractors underperforming for the week. Onto the heat map for the ETFs, green across the board. Again, the laggards, XLP, this is consumer defensives, utilities, the XLU, XLV in healthcare, notable absence here. And of course, you see growth, IWF, VUG outperforming value by a lot, be it value did close positive for the week. But in the last few days, the underperformance by energy and commodities, but specifically energy because gold has been outperforming since the beginning of the year. But energy has been lagging. In the last couple of days, they made a comeback. XOP closed positive, XLE closed positive, OIH closed positive, big time. So I'm sensing here a revival of the energy trade so long as the dollar continues to go down and so long as the Fed chooses scenario number 1 that we talked about in the In Focus segment. By the way, if you're hearing some noise in the background, the wind is really strong right here. It feels like a hurricane, but anyhow, let's move on to the charts analysis, and we begin with the SPY, the S&P 500 30 minutes chart. What do we have here? Technically, the chart did close above the important number of 398. With that being said, it did not close above it decisively. On top of that, we have negative divergence on the RSI. My assumption is this is a good time if you played this rally to take some profits off the table and perhaps bet on a pullback. We're not saying a reversal yet because the daily, the weekly charts are not signaling any of that yet. Keyword yet. But perhaps we have a pullback coming here. So take your profits, at least take some chips off the table here if you played this rally the right way. Now the pullback could take us all the way down to 393.16. That would be not a big pullback, but a decent one. It could take us all the way to 391. My assumption is if we have a pullback, it goes down all the way to 391 and perhaps close the gap below it. Here's the daily chart for the continuous contract for the S&P. No problems for now. We're not seeing any sign of a reversal whatsoever. Matter of fact, the chart closed above 3,960 and above 4,000 on a weekly closing. You cannot look at this as a bearish signal at all, at least from a technical standpoint. The volume is good, the RSI is moving higher, so is the MACD. We're not seeing any problem here. But we do have some resistance coming, and that is the top of the breakdown candle. That would be 4,037. So watch how the chart is going to react around this number. But bear in mind, when we zoom into a 30 minutes chart, look at the discipline in the move so far. The chart goes down to the support line, in this case 3,960. Test, another retest over and over again. And then it gets the confirmation that the support is okay and higher it goes. So for now, you can't be too bearish here looking at this chart, but it is a good opportunity to book some profits at least for now. How about the Qs, 30 minutes chart? And by the way, I'm skipping the SPX because we covered that in the In Focus segment, but here's the Qs, 30 minutes chart. Similar story here. We have a closing above the important resistance line, 280, but is it a decisive and convincing close? The answer is not quite, so the chart is susceptible for a pullback. If we do have a pullback, it could take us all the way down to close the gap at around, let's say, 274. That could be a decent pullback to play, but be careful of becoming too bearish here because here's the daily chart for the continuous contract. Above the important number, 11,058.5, it did not close above another important number that could have been a confirmation, which is 11,689. But so far, the momentum indicators, be it the RSI or the MACD, remain positive and they remain firming up. Sure, the RSI is kind of stalling here. And remember, the RSI is a leading indicator. MACD is a lagging indicator that we use for confirmation. So I'll be watching these two closely. Now here's the IWM 30 minutes chart for the Russell 2000. I'm out of this one. It doesn't make sense to be too greedy right now. Yes, we have a resistance ahead. The chart could go all the way to this resistance. It could rally a little more, but we're seeing negative divergence in the 30 minutes chart. That means we could see a pullback. If we have a major pullback for now, it could take us all the way down in a retest to 183. Now, mind you, here's the monthly chart for the IWM. Believe it or not, it did not break its trend line that goes all the way down to 2009. So this is a critical point for the IWM. Either it keeps this support line, and so far it did, but the test now becomes, can it move away from the trend line and create another rally higher? My hunch is it will fail because we have a big divergence above the trend line, and usually in a correction, we also have a big divergence on the other way, this time around below the trend line. But this is a monthly chart. This is a long-term chart. It's not going to play out right away, but you got to keep your eyes on one number here, which is a top of a breakdown candle, 202. Maybe we could rally all the way to 202. If the chart closes above this number on a monthly basis, good sign for the IWM. On the other hand, if it fails, if it gets rejected from the same number, And if it fails to close above this number on a monthly basis, bad sign, it will be a leading indicator that the IWM will crack below the trend line once and for all. Dixie, the dollar index daily chart, what's going on here? It could not recapture 103 no matter how hard it tried over and over again. And we do have a confirmation now for the MACD of negative momentum in the dollar, which means it could flush down all the way to the next support of about 99.9. Now, when we look at the weekly chart for the Dixie, what do we have here? We have a curved pattern that acts as a wall of support. Every time the chart pulls back to meet this curved line, it bounces back. Now, this is the opposite of the curved pattern that we covered on Tesla's chart. That was a bearish one. Every time the chart attempts to crack above the curve, it pulls back again. It acts as a wall. But once we have a break one way or the other, the momentum changes. And the moment the dollar broke below the curve pattern, the momentum changed from positive to negative. And the question becomes, where is the support here? We talked about 99.9 from a daily chart perspective, but from the weekly, we have a consolidation pattern that goes all the way back to 2020. And that could be a support zone, including 99.9, but it also includes 98 all the way to 100. So the dollar could find support anywhere in this zone. But for now, the assumption is it continues to go down until we go all the way down to this support zone. Now, if you want to read a little too much into it and reading the tea leaves, you put 2 and 2 together, the dollar goes down all the way, cracks below 100, inflation rebounds higher. Here comes Jerome Powell in the next FOMC. He comes out hawkish and the dollar rebounds from the support zone. I'm just reading the tea leaves here. Now, when it comes to gold, the daily chart, the rally continues. But again, it's getting a little overbought. I'm not falling into this. I'm not loving this. You could say, hey, Maverick, you got sour grapes because you missed the rally in gold. You might be right. You're absolutely right, actually. But here's the thing. Even last year, we have seen a rally in gold and then gold went down again. And when gold rallies impulsively higher, in a short amount of time, I'm not chasing here. I need to see more confirmation. I need to see the Fed confirming that they're not going to revive the dollar higher, that they're going to fall into the trap of scenario number 1 that we discussed in the In Focus segment. I think gold will top at some point really soon, pull back, and then I'm going to reassess and enter gold if I see an opportunity. Now the question becomes, if the rally continues in gold, how high can we go? And to answer that, we zoom out to a weekly chart and we see that the important number here is, at least to my assessment, 1965.5. Now if gold gets there, and you've been in the rally to begin with, that would be a good point to take some chips off the table at least. Now let's look at Brent oil, the daily chart. Again, we have a higher low pattern. This is positive. So long as it keeps 77 as support, so far so good. Here's the bad news. We have some resistance here at 85. If the chart moves back and creates a higher low once again, then the assumption becomes it's going to crack above 85 once and for all, because it would be a pullback to gather some much needed energy to crack above 85. That is bullish, not bearish. 77 is cracked, we have a major problem here. Yet when we look at the weekly chart for UK oil Brent, what do we see here? Look at the RSI reversing negative divergence. Look at the MACD attempting at least to reverse the negative momentum here. It is just a matter of time. If the dollar continues to go down, we will see a rebound in energy prices, which will come hand in hand with the revival of the energy trade that we talked about in the last video. Now here's the 10-year yield, the daily chart. What do we see here? We have a rebound, an attempt to crack above 3.5 once again. Whether that's going to be met with success or not, it all depends on what the Fed is about to signal. We have a bunch of zombies who are going to speak this week. Stick around to the conclusion of this video. TLT. Again, can we see a pullback and a retest of the support of 103.5? The answer is absolutely possible. And therefore, I'm not chasing the rally in the TLT. Get above 109.5, close above it for the week, and then I'm interested. Here is the VIX 4-hour chart. A massive meltdown here. The chart initially attempted to crack above 21.83. It was met by massive rejection, and this massive rejection didn't even stop at 20. It flushed down all the way. And now the VIX is at 18.37. Here's my hunch. The VIX will retake 20 in no time. It will become support in no time. And the reason behind that, while money managers for now are losing their minds, they're becoming jubilous, they're not really that stupid after all. When they see the VIX below 20 in an aggressive fashion, And we're still not out of the woods when it comes to this tightening campaign and fighting the Fed. Oh, and on top of that, the market rallied too hard, too fast. They will see this as an opportunity to at least hedge and buy some put options to protect some of these gains they captured so far. That will push the VIX right away above 20 in no time. Apple 30 minutes chart, again, just like with the discussion in the SPY and the Qs, it did close above the important resistance, in this case, 134.37. But is it decisive? Is it convincing? The answer is none of that, and therefore, if you've been playing the rally in Apple, this is again a good time to book some profits, at least take some off the table. And maybe you want to use the same strategy as the fund managers and protect some of your gains by buying some puts, at least in the SPY. Because even if Apple rallies a little more, it has another stiff resistance at around 135.36, which also happens to be a gap fill. About Tesla, an hourly chart, the saucer bottoming formation is out of the picture right now because the chart made a lower low. That's the bad news. The good news for the souffle enthusiasts is the following. When we switch to a line chart, what happened all in all? We have a consolidation pattern. The chart is still above 113. The chart did not make a major lower low. And all in all, this could be a reverse head and shoulder formation, which will take us above 128.62. Now, if you've been waiting in the sidelines, you're not engaged in Tesla one way or the other, but maybe you're feeling a little bit of FOMO and you want to buy some calls in Tesla, why not wait until the name closes above the important resistance of 128.62, and then you got the green light to chase the rally. Speaking of the rally, look at Bitcoin, tulips, daily chart, massive pop higher, and it did close above the important number of 20,593.34. Here's the problem. It is becoming really overbought. A big rally in a short amount of time. This will create overbought conditions in the RSI. In return, the algos are going to react appropriately by dumping Bitcoin. So we could see a pullback. Now, here's what you want to watch for. If we do have a pullback in Bitcoin, could it be a formation of an A-B-C pattern? We're done with the A, the pullback would be B, and then the C leg takes us higher to make another higher high. What you want to watch for is when will the B leg stop? If it stops in, let's say, 19,000, anywhere above 18,000, and it rebounds higher again, that would be a buy signal. But if it continues to melt down and it loses, I would say, to be conservative, 18,500, then we got a problem here. This could be just a quick pump and dump, a dead cat bounce, and down we go from this point on. And lastly, moving on to the conclusion of this video, what do we have on the economic calendar this week? Tomorrow, Tuesday, January 17th, we have the Empire State Manufacturing Index. Wednesday, the 18th, we have retail sales, we have the PPI, we have industrial production, capacity utilization, the Home Builders Index, business inventories, along with the most important beige book from the Fed. Now, when it comes to Thursday, January 19th, we have the initial jobless claims, we have building permits, housing starts, we also have the Philly Fed Manufacturing Index, and we have another zombie from the Fed. This will be an important one. We have Mrs. Brain Dead, the vice chair, speaking. Is she going to go with scenario number 1 and buckle, or stick to her guns in scenario number 2? And then ending with Friday, the 20th of January, we have existing home sales, and another Fed zombie, this time around Governor Waller speaking. Let's hear what he has to say. Folks, the last note that I have is, if you're a member of this channel, we have portfolio review coming. I'm going to work on that right away after I'm done with this video. Now, it could take a little while. I might not be done with it until later this evening or maybe earlier tomorrow. But again, it's not a time-sensitive thing. You get it when you get it. You look at it when you have to look at it. And I want to do a good, thorough job. I don't want to rush it. Anyhow, folks, this wind and rain is driving me crazy. So let's end it here. This is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow. Take care.
The last thing I took away from the yeshiva is this. We can't run from who we are. Our destiny chooses us.